Compound interest is a financial concept where interest is not only earned on the initial investment or principal, but also on the accumulated interest over time. This results in exponential growth, as the investment generates returns that are reinvested to generate even more returns. Compound interest plays a crucial role in various financial products and strategies, such as savings accounts, retirement accounts, and investment portfolios. By harnessing the power of compound interest, individuals and organizations can grow their wealth significantly over time, making it a fundamental tool for long-term financial planning and wealth accumulation. Compound interest is a fundamental concept widely used by individual investors, financial institutions, retirement savings, education savings, investment funds, insurance products, wealth management. Suppose you invest $1,000 in a savings account that pays an annual interest rate of 5%, compounded annually. After the first year, initial investment, principal, $1,000 interest earned. $1,000 at the rate of 5% is $50 total amount at the end of the year. $1,000 plus $50 equals $1,000 and $50. After the second year, initial investment, principal, $1,000 and $50, includes previous year's interest earned. $1,000 and $50 at the rate of 5% is $52.50 total amount at the end of the year. $1,000 and $50 plus $52.50 equals $1,102.50. After the third year, initial investment, principal, $1,102.50, includes previous year's interest earned, $1,102.50. At the rate of 5% is $855.13. The total amount at the end of the year, $1,102.50, $55.13 equals $1,157.63. Exponential growth. Compound interest refers to the process where the interest earned on an investment is reinvested, leading to exponential growth over time. As interest is earned on both the initial principal and the accumulated interest, the investment grows at an increasing rate. Time horizon. The longer the time horizon, the more significant the impact of compound interest. Due to the compounding effect, even small contributions or interest rates can lead to substantial growth over extended periods. Starting early and allowing investments to compound over time can greatly enhance long-term wealth accumulation. Frequency of compounding. The frequency at which interest is compounded affects the overall growth of an investment. Investments that compound more frequently, such as daily or monthly, will grow faster compared to those compounded annually or semi-annually. Understanding compounding frequency allows investors to choose investments that maximize growth potential. Rule of 72. The Rule of 72 is a useful rule of thumb to estimate the time it takes for an investment to double in value based on its compound interest rate. To apply the rule, divide 72 by the annual interest rate, expressed as a percentage. The result is the approximate number of years it takes for the investment to double. For example, with an annual interest rate of 8%, it would take approximately 9 years, 72 and 8, for the investment to double in value. Understanding compound interest and its implications can help individuals make informed decisions about saving, investing, and planning for the future. By harnessing the power of compound interest, investors can work towards achieving their long-term financial goals and building wealth over time. Modern investment vehicles that leverage compound interest include stock market. Investing in stocks allows investors to benefit from the compounding growth of share prices over time. Dividends received from stocks can also be reinvested to further compound returns. Exchange-traded funds, ETFs. ETFs are investment funds that hold a diversified portfolio of assets, such as stocks, bonds, or commodities. Investors can buy shares of ETFs, which often distribute dividends or interest income that can be reinvested to compound returns. Mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities. Similar to ETFs, mutual funds may distribute dividends or capital gains that can be reinvested to compound returns. Retirement accounts. Retirement accounts such as 401ks, IRAs, and Roth IRAs allow investors to save for retirement while benefiting from tax-deferred or tax-free growth. Contributions made to these accounts grow over time, compounding returns until retirement age. Real estate. Investing in real estate properties or real estate investment trusts, REITs, can provide opportunities for compound growth through rental income and property appreciation. Peer-to-peer lending. Peer-to-peer lending platforms allow individuals to lend money to borrowers in exchange for interest payments. Reinvesting earned interest can compound returns over time. Robo-advisors. Robo-advisors are automated investment platforms that use algorithms to create and manage diversified investment portfolios based on investors' goals and risk tolerance. Robo-advisors often reinvest dividends and interest income to compound returns. Cryptocurrency. While volatile, investing in cryptocurrencies such as Bitcoin and Ethereum can provide opportunities for compounding growth as the value of these digital assets appreciates over time. These modern investment options offer various opportunities for investors to harness the power of compound interest and grow their wealth over the long term. However, it's essential to conduct thorough research, assess risk tolerance, and consider investment goals before selecting investment vehicles. Additionally, seeking advice from financial professionals can help investors make informed decisions tailored to their individual circumstances. Don't forget to like, share, and subscribe for more valuable insights on investment strategies and financial literacy. Stay tuned for our next video where we'll explore another exciting topic in the world of finance. Until next time, happy investing!